All right, welcome to This Explainer. Today, we're diving straight into the massive, totally invisible life decisions that are silently draining your net worth, especially during your 20s and 30s. Look, we've all heard the standard, recycled financial advice, right? Skip the daily latte, don't eat out as much, save a few bucks here and there. But today, we're completely bypassing those surface-level tips. Instead, we're going to unpack the foundational life choices that actually dictate your financial trajectory. And to really set the stage, listen to this hard-hitting quote from the source material. The creator noted that his father, a guy who worked incredibly hard and did almost everything right financially, was divorced 3 times. And because of that, he felt like he was starting completely from scratch at age 50. This perfectly illustrates that building real wealth, it isn't just about grinding harder or avoiding daily splurges. It's about how you navigate the huge, monumental life choices. The biggest wealth killers out there are silent. They're just siphoning money from your future without you even noticing. So, to make this explainer super actionable, we've organized these wealth traps into 3 core pillars. First, work and location choices. Second, lifestyle, ego, and relationships. And third, money management mistakes. Let's get right into it. Starting with phase 1, work and location choices, because where you plant your roots absolutely determines your growth. Okay, so a massive wealth killer that almost nobody talks about is simply staying in the wrong city. Geography is arguably one of the most critical financial decisions you'll ever make. Just look at this comparison. The median household income in a place like Kansas City is roughly $69,000 a year. But if you pack up and move to a high-opportunity hub like San Francisco, that median salary practically doubles to over $135,000. Now, you might be thinking, yeah, but the cost of living is way higher. And sure, it is. But if you keep your lifestyle in check, you get to pocket that massive difference in raw dollars. The source material actually brings up this fascinating real-world example of geographic arbitrage. Italian workers who literally commute across the border to work at a gold factory in Switzerland. Why? So they can earn those premium Swiss wages while still paying cheaper Italian living costs. The takeaway here is absolutely crucial. Your first salary becomes the anchor for every future negotiation you ever have. If you default to building your career in a low-opportunity city, you are anchoring your lifelong wealth potential to a significantly lower baseline. Next up, be aware of what we call sunk cost loyalty. I mean, so many of us are culturally conditioned to just be grateful we even have a job. We get comfortable, we really like our coworkers, and so we stay. But honestly, staying too long is a trap. Let's say you start a job out of college at a large hospitality group making around $60,000. They might toss you a standard 3% raise every couple of years to keep pace with inflation. But after a decade, you're barely cracking $70,000. Look, companies aren't just running around handing out raises out of the goodness of their hearts. They pay you exactly what they have to keep you, and not a penny more. But check this out. According to LendingTree data cited in the source, workers who strategically hopped to a new job saw their earnings jump an average of 11%, and in some cases, a massive 30%. By intentionally switching jobs every 1 to 2 years early in your career, you are completely resetting your day's salary, which just supercharges your compounding wealth over time. Which brings us to another huge career choice: how you get paid. A major wealth killer in your 20s and 30s is optimizing strictly for a cash salary and totally ignoring equity. It is so tempting, I know, to just take the higher base salary so you can afford a slightly nicer apartment or inflate your lifestyle today. But a single, solid equity outcome, that can literally outperform an entire decade of salary. Now, obviously, you have to do your homework. If it's a legitimate, growing company, you need to know exactly what you're signing up for. First, don't just get blinded by the raw number of shares they offer you. Figure out what actual percentage of the company you own. Second, try to estimate what that tiny percentage would actually be worth during a future valuation or an IPO. The point is, taking on a little calculated risk with equity, rather than playing it 100% safe with cash, can give you the massive upside you need to build real, life-changing wealth. All right, moving on to phase 2, lifestyle, ego, and relationships. Or, as I like to call it, the unbelievably high price of trying to look rich and splitting your assets. So you definitely, absolutely want to avoid becoming the 30K millionaire. It's a funny term, but it perfectly nails the toxic, wealth-destroying behavior of trying to keep up with the Joneses. It is totally natural to want to measure your success against your peers or against whatever influencer you're scrolling past on Instagram. But you have to remember, what you see online is heavily curated, it's a highlight reel. That brand new car is probably leased, the designer clothes might be borrowed, and that luxury high-rise apartment is probably eating up 60% of their take-home pay. The source material shares this hilarious yet painfully accurate definition from Urban Dictionary. It's the guy who buys the VIP table at the club, but then literally can't afford to buy a single drink because the table drained his bank account. Seriously, the people who look like they have all the money often have very little to their name. Meanwhile, the folks in plain t-shirts and regular jeans, they're usually the ones quietly building mega wealth by staying in their lane and living below their means. And hey, speaking of looking rich, let's talk about the ultimate modern status symbol, your car. Buying too much car is a massive wealth killer. Get this, in 2026, the average price of a brand new car crossed the $51,000 mark. That translates to a monthly payment of over $750. And when you add in insurance, the rapid depreciation, maintenance, and gas, your true cost is easily blowing past $1,000 a month. But let's look at the alternative. If you just swallow your pride and buy a reliable, slightly used car, maybe 3 years old, 30,000 miles on it, the average payment drops to $537. That's a clean difference of $213 every single month. If you took that $213 and just passively invested it in the market at an 8% return for 10 years, you'd have an extra $45,000 sitting in your account. Think about it. Your commute is exactly the same. You still get from point A to point B, but your ego isn't actively vaporizing your future wealth. Okay, we're arriving at what might be the most uncomfortable wealth killer on our list, but we absolutely have to talk about it, your relationship choices. Picking the right life partner is arguably the single most important financial decision you will ever make. The US actually has the 6th highest divorce rate in the entire world, with 40 to 50% of first marriages ending. And it gets even wilder. The divorce rate for second and third marriages skyrockets to 60% and 73%. But despite those terrifying statistics, only about 15% of couples actually sign a prenuptial agreement. When you look at what drives this, the source points to a lack of commitment, infidelity, excessive conflict, and, crucially for us, financial problems and just getting married way too young. So why exactly is this such a catastrophic wealth killer? Well, standard legal fees alone can easily run past $20,000, but the real financial devastation is in the hidden costs. Imagine you own a house together. If you split, you might be forced to refinance that house at today's terrible interest rates. Or worse, you have to sell it during a market downturn and lock in a massive loss. Then you have to split up your retirement accounts, which usually requires specific court orders and can trigger brutal early withdrawal penalties and taxes. Throw in the cost of relocating, buying all new furniture, and the sheer nightmare it becomes if one of you owns a business. All told, a divorce can easily cost you anywhere from $50,000 to well over $100,000. The bottom line here is that who you choose to marry can literally make or break the wealth you're trying to build. Let's transition into our final pillar, Phase 3 Money Management Mistakes. We're talking cash drag, market timing, and toxic debt. All right, we all know the golden rule. You need an emergency fund. Standard financial wisdom says to keep 3 to 6 months of living expenses tucked away for a rainy day, like a job loss or a surprise medical bill. But here's something really fascinating. You can actually be too safe with your money. The source material points out that some people keep $80,000 or even up to $160,000 just parked in a savings account because it makes them feel secure. But let's run the math real quick. If your monthly expenses are $4,000, a totally reasonable 6-month safety net is $24,000. But if you're holding on to a 16-month fund, you've got $64,000 just sitting in cash. That's $40,000 of pure excess. Hoarding that much cash is usually just a symptom of a scarcity mindset, and let me tell you, it comes with a massive invisible price tag. And here's exactly what that false sense of security costs you. If you leave that extra $40,000 sitting in a high-yield savings account earning, let's say 3.5%, instead of investing it in the market, which historically returns around 8 to 9%, the opportunity cost is just staggering. Over a 20-year period, playing it that safe will literally cost you about $145,000 in lost wealth. Let that sink in. Be highly intentional about how much of a catch buffer you actually need, because being excessively safe is a massive financial leak. Which perfectly tees up our next silent wealth killer, staying on the sidelines because you're waiting for the perfect time to invest. So many people hoard cash, waiting for the market to cool off, or hoping to buy the dip. But trying to time the market is basically a fool's errand. Let's look at a $10,000 investment in the S&P 500 from 1996 to 2025. If you just put it in and left it alone, you'd have over $192,000. But if you tried to get clever, timed the market, and ended up missing just the 10 best performing days over that entire 30-year span, your gains plummet by 56%. If you miss the 30 best days, you suffer 84% less gains.
Your entire portfolio's growth heavily relies on just being in the market for a handful of its absolute best days. So unless you're literally retiring tomorrow, stop trying to time the market, just get in and stay in.
Furthermore, you absolutely cannot build wealth for the future if you are dragging around toxic debt. Now, to be clear, not all debt is bad. A mortgage for a home or a loan for a highly lucrative degree, those are calculated uses of leverage. But high-interest consumer debt, specifically credit cards, that is an absolute wealth destroyer. As of 2026, the average interest rate for credit cards hit a mind-blowing 22.11%. To put that into perspective for you, if you're carrying a $10,000 balance, you're paying roughly $185 every single month just in interest. That is your hard-earned money literally evaporating into thin air. It can never be invested, it can never compound, it's just gone. One of the single best financial decisions you can possibly make in your 20s and 30s is to aggressively, completely eradicate high-interest debt from your life.
And that brings us to our resolution: breaking the cycle. It's all about choosing intentionality over your ego and your fear. Building genuine, lasting wealth requires a massive mental shift. You have to actively move away from the ego-driven trap of keeping up with the Joneses, and you have to abandon the extreme fear that makes you hoard cash or settle for tiny, safe annual raises. It demands highly intentional lifestyle design. So, as we wrap up this explainer, I want you to take a really honest look at your own financial life right now and ask yourself this one critical question: which of these silent wealth killers are you currently battling? Figure it out, stop that invisible drain today, and start compounding your real wealth for tomorrow. Thanks so much for joining me on this explainer, and I'll catch you in the next one.